This is Macro Horizons, episode 336, Sights on September, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of August 11th. And as we expect, the September rate cut debate will soon shift to 25 versus 50, we can only look forward to the too late, too small, too bad social media posts that are sure to follow. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market continued to digest the disappointing employment report and the implications for monetary policy going forward. The consensus has landed on a 25 basis point rate cut in September. However, it is important to keep in mind the market will still have the benefit of 2 additional CPI prints as well as the August employment data, all of which could possibly skew the market toward a 50 basis point rate cut. Although this is not our base case scenario, it is certainly a risk that's on the radar. Another key takeaway from the week just past was that the Treasury market, despite supply, continued to trade with a bond bullish tone. Now, this is certainly consistent with the relevance of the employment update, and it's important to keep in mind that it wasn't the July payrolls print, which showed a growth of just 73,000 jobs, but rather it was the downward revisions to the May and June numbers. In light of these downward revisions, the Fed and the market now have 3 clear data points that show weakness in the labor market, and that's likely to be more than sufficient for the Fed to justify a 25 basis point insurance cut, if nothing else, in September. This now also implies that the data that will be released over the next several weeks will have implications for the October and the December meetings more than September per se. Again, we're assuming that the Fed doesn't decide to go 50 basis points. We also will get the updated SEP and dot plot at the September meeting, and that will give the Fed another opportunity to provide the market with some forward guidance as it pertains to what at that point will be the last 2 meetings of 2025. It goes without saying that at this stage, the market is expecting that the Fed will have returned to a version of neutral policy by the middle of next year. We have penciled in a 3% Fed funds rate by the end of 2026, which is notably below what the recent dot plot suggested, but it's also very consistent with what the futures market is pricing in at the moment. This all leaves us to expect that over the course of the balance of the summer, that yields are going to continue to drift lower. A 3 handle on the 10-year certainly isn't an impossibility, particularly in the event that some of the data disappoints. But at the end of the day, the bigger takeaway is that we're not going to be revisiting 475 or 5% 10s, and we're more than likely going to find the Treasury market in a very familiar trading range. We continue to favor curve steepening trades, particularly anything that is anchored to the 2-year sector, given how we expect the policy debate to develop over the course of the next several weeks. If in fact there's a case to be made for a 50 basis point rate cut, then there's a stronger case to be made for 2-year yields declining even further, and that will ultimately push the yield curve notably steeper.
Well, obviously it was going to be an informative week, not necessarily as a function of the new economic data we have on offer, because there wasn't any, but rather to see how the market responded in the follow-through to last week's ugly payrolls report and the growing prospect, dare we say base case, for the Fed to resume the cutting process in September, given the signs of weakness we saw in July's jobs numbers. And the market's reaction in Treasuries resonated with the idea that the easing campaign is going to resume sooner rather than later, and in this context, while 10-year yields retraced modestly off the lows we reached last week, at 425 with the current labor market backdrop, it's become clear that the dip buying bias is going to become more pronounced going forward, and that's probably going to limit the scope of sell-offs from here, which is one thing if we were at 450 or 475 10-year yields, but it paints an entirely different picture in terms of the outlook for the path of rates over the balance of 2025. A dip buying bias from a range of 450 to 475 leaves much different levels on the table for year-end 10s than a departure point of a range that's 50 or 60 basis points lower.
In fact, this is all very consistent with our outlook for 10-year yields, where we have a forecast for the end of 2025 at 385. We've also been assuming that the front end of the market is going to continue to rally further and have 2-year yields penciled in at 325, which implies a 2s-10s curve at 60 basis points. That being said, given the balance of risks at the moment, we would skew our 2-year forecast lower to perhaps 3%, which would imply an even steeper yield curve. With a 25 basis point rate cut in September now priced at a 90% probability in the futures market, we expect that over the course of the next several weeks that the debate will become whether or not the Fed chooses to go 50 rather than 25. Our base case scenario is still 25 basis points, and we think that the bar to cut 50 basis points in September is very high and would require another significant downgrade in the outlook for the labor market, as well as particularly benign inflation prints for the months of July and August. Now, both of those outcomes certainly are not impossible, but we expect that there will be pockets of goods inflation based on tariffs and the trade war, and while service sector inflation might moderate as a result of the increase in goods inflation, that dynamic won't play out within a single month or two's worth of economic data, but rather will be a broader trend that could come to fruition by the end of the year.
And given the next Fed debate is going to be centered around whether or not September's cut needs to be 25 or 50 basis points, it's precisely that dynamic that's probably going to dictate just how dovish the Fed will become over the next several weeks. Remember, before NFP and what we heard consistently as recently as the July press conference was that the Fed acknowledged there were downside risks facing the labor market, but those concerns were outshadowed by the upside risks to inflation, specifically on the good side, as you mentioned, Ian, related to the uncertainty around tariffs and what will ultimately be passed through to end users. Yes, it is just a one-time price reset and not true demand-driven inflation that will compound on itself year over year, but especially as we see headlines from large corporates around the business impact of tariffs, the Fed needs to be cognizant of the growth negative implications of tariffs that present another downside risk to the labor market, and also the price ones. And given the preference for patience that we've heard from Powell, we suspect a more measured approach, aka a 25 basis point cut, will be the path of least resistance. But we do have 2 more CPI prints and another jobs report to contend with before the September meeting, and if inflation continues to be relatively benign now that we have 4 or 5 months of tariff impacts behind us, and or the labor market shows more material weakness, there's nothing that would prevent the Fed from going 50, and President Trump would love that.
Well, one thing is clear. If the CPI prints come in higher than expected, Trump won't fire the head of the department that produces them.
Been there, done that.
You can't fire me twice. I quit. But on a serious note, Trump's decision to announce that he would be replacing the head of the BLS immediately after the disappointing payrolls report, which included downward revisions to the prior 2 months of 258,000, certainly does raise questions about the credibility of the economic data going forward. That being said, to the president's defense, investors have spent a lot of this year questioning why payrolls continued to come in stronger than expected while we had anecdotes, whether it was the ADP or jobless claims or many of the other job proxies that suggested that we should be at a lower level for net payrolls gains. Now, to some extent, the BLS as an institution isn't necessarily to blame for the significant revisions, because post-pandemic, we have seen a significant fall-off in the response rate in the establishment survey. So if firms are not reporting to the BLS, the accuracy of the early estimates from the BLS will, almost by definition, be lessened and therefore subject to greater revision. All that being said, if the president continues to replace the head of institutions that are producing economic data that doesn't conform with his view of the real economy, investors will find themselves in a precarious situation, to say the least.
And aside from the follow-through to jobs, what it means about economic data, what it means for the Fed, we also got the 10-year refunding auction this week that, as has been the case throughout the new administration's tenure, was closely watched as an indication of demand for the long end at these yield levels. It's a far different paradigm on the issuance front than it was, say, immediately in the wake of the election, when there was the expectation that massive increases in borrowing would translate to a bear steepening of the curve, as larger long-end auction sizes would be met with an ambivalent investor base that would be unwilling to take down larger supply. Instead, obviously, what we've seen, reinforced by the refunding announcement, is that the Treasury Department is far more focused on increasing bill auctions and, in fact, is extremely reluctant to do anything other than potentially deliver a downsizing in the long end of the curve. And so, to see the result at this week's 10-year auction, which tailed a reasonable amount and, more interestingly, showed the lowest end-user allocation since last August, but maybe it's an August thing, the weakness at the auction failed to trigger any material follow-on weakness, and instead, what we saw in the hours and session that followed was what ultimately proved to be a textbook concession for the larger new issue auction that was taken down relatively well, and the market moved on. It's also worth considering the intraday volatility we saw on Wednesday specifically related to what we're hypothesizing is a large deal flow going through a market that is suffering from a classic case of August liquidity, and the fact that we saw 30-year yields, for example, rise 3 basis points in the middle of the day on no news whatsoever, surely left some would-be demand for 10s on the sidelines or at a minimum more conservative buy levels at the auction. A 0.9 basis point tail for a newish or 10-year auction is soft, to be sure, but hardly a game changer, and we struggle to draw any larger read-through for what it means for Treasury demand as a whole, especially at these rate levels. After all, we've rallied quite a bit since last Friday.
And it's important to keep in mind that the market did trade well despite the auction results. And what this suggests is that several of the key bond bearish underpinnings that have been with us since Liberation Day have become de-emphasized in the wake of the disappointing payrolls print. Specifically, recall that the narrative was that the trade war would lead to such a dramatic reflationary environment that break-evens would spike and 10-year yields would go back to 4.75 or 5%. But the reality is that has not occurred, in part because June's inflation print showed a contained, not broadening set of inflationary pressures, but also because we have now seen some of the fallout in the labor market. And a weak labor market will hit demand, and lower demand has disinflationary implications. Let us not forget that a significant federal deficit was also considered to be a bond bearish story, but now that the refunding announcement has made it clear that coupon auction sizes will not be increasing and that the bill market will be utilized to fund the deficit for the foreseeable future, the supply and term premium argument underlying the case for higher yields has been significantly offset. And when combining this all with a lack of a buyer's strike, as you pointed out, Ben, the reality is that we're back to trading the fundamentals of growth and inflation expectations, and with inflation expectations contained to this specific sector of goods, and the growth half of the equation becoming a bit more circumspect given the trajectory of the labor market, it follows intuitively that 10-year yields are closer to 4% than they are to 5%.
And it's obviously not solely a U.S. story. There's growth worries in the U.K., in Europe, in Asia. We saw another cut from the Bank of England this past week. And it's all these factors, and you put it well, Ian, a refocus on the economic outlook and the fundamentals of growth, inflation, and the labor market that we expect will continue to overshadow term premium and supply-driven considerations and leave the balance of summer and heading into autumn as a period that's probably best characterized by a grind toward lower yields, and we continue to look to 4% 10s as the next stop.
Well, like they say, if the supply doesn't get you, the employment will.
Do they say that?
Nah, but they should. In the week ahead, the Treasury market will get the July core CPI numbers, which, for all intents and purposes, we expect will solidify rate cut expectations for the month of September. Now, to be fair, the timing of the September 17th FOMC meeting also means that the Fed will have the benefit of August's employment and CPI data before they decide on the magnitude of any rate cut. Nonetheless, the market will be focused on the details of the upcoming CPI print to set the tone for trading over the course of the next few weeks, if nothing else. The consensus for core CPI is a 0.3% increase. Within the details will be core services excluding OER and rent. This, also known as the supercore measure, is the aspect of the report that has the highest correlation with nominal wages and would be the sector in which we would see any broadening out of inflationary pressures beyond the goods inflation that's related to the trade war and to some extent is a foregone conclusion at this point. As long as we don't see goods inflation spilling over into service sector inflation, then the Fed will be comfortable with their characterization of the fallout from the trade war on the inflation side being temporary and simply a one-time price adjustment as opposed to rekindling the type of inflationary pressures that followed the pandemic. The market will also have the benefit of PPI and import prices from which to estimate the impact on core PCE. Said differently, by Friday, August 15th, the market will have a fairly full understanding of how the Fed's preferred core PCE measure performed in July. Let us not forget, we also see the retail sales figures for the month of July. Here, the market is anticipating a 0.6% increase in sales. However, it's worth noting that the combination of Q1 and Q2's personal consumption data suggests that households are beginning to struggle somewhat. The offset being the correlation between risk assets, notably the U.S. equity market, and the pace of consumption for the top quartile of households. The wealth effect has been important in driving both consumption and also some of the stickier pockets of realized inflation. The fact that equities quickly recovered, not only after the Liberation Day sell-off, but also after the recent disappointing payrolls print, suggests that the wealth effect will at least marginally help cushion any downside risk for consumption that results from a weaker labor market outlook. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the Fed's Jackson Hole Economic Policy Symposium quickly approaches, apparently once again this year, our invitation got overlooked. We'd like to say that there's still time, but frankly, the only thing that comes to mind is too late. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.